Profit is the easiest number to fake. You don't need real cash. You don't need sustainable growth. You just need timing, accounting, and a good story. And when a company shows record profits, most investors assume the story must be true. That's where they lose, because the numbers you see aren't the numbers that matter, especially with companies that scale through debt, especially when interest costs are high and repayment risk compounds quietly in the background, and especially when headlines distract you from the part of the business that's bleeding. This isn't just about SoFi. This is about what most investors never ask. What does it cost to make these profits, and how much of that money actually sticks? If you don't have a real answer, you don't have a real thesis. And if you're making decisions based on headlines, you're already behind. Where SoFi is actually killing it. Most of the attention goes to SoFi's lending arm, but the real signal, it's coming from the financial services side. That's where the flywheel is quietly starting to spin. Deposits are up 23% quarter over quarter, now sitting at $18.6 billion. More importantly, over 90% of those deposits come from direct deposit members, sticky money from sticky users. That drives down funding costs, improves margins, and gives them control that other fintechs don't have. Membership grew 44% year over year, hitting $7.5 million total. But it's not just growth, it's depth. Users are adopting more products. Engagement is rising. SoFi isn't just acquiring customers, they're embedding themselves. And when you zoom in on their tech stack, the value becomes even clearer. Galileo processed approximately 2 billion transactions this quarter. That infrastructure lets them monetize scale without having to originate loans. That's leverage, and that's what SoFi needs more of. Here's what this really means. SoFi's financial services and technology arms are no longer just support functions. They're revenue engines, and they're growing faster than the lending side. This is the part of the business that could become durable. It's scalable, it's less capital intensive, and it gives them pricing power if they execute well. If SoFi wins in the long term, this is how they do it. Not by becoming a loan machine, but by becoming the rails the next generation of finance runs on. So do they have record numbers or just window dressing? SoFi just posted the best quarter in company history. Revenue hit $950 million. Net income came in at $139 million. Adjusted EBITDA margins hit 29%. This is what Wall Street calls a breakout. But let's not pretend a clean print means a clean business. Because when you strip away the packaging, one thing becomes clear. Almost every highlight came from the lending engine, and that engine is running hot. Personal loan originations jumped 53%. Student loans tripled. Home loans doubled. Lending made up over 56% of total revenue. That means more balance sheet exposure, more credit risk, and more reliance on a very specific kind of customer behavior, staying consistent in a market that's anything but. Yes, financial services grew 76%. Yes, technology revenue climbed 6%, but these segments still aren't pulling real weight. Lending drives this story, and that's exactly where most of the risk lives. Here's the problem. When over half of your growth comes from originating debt, you're not building a flywheel. You're feeding one. The moment that demand slows or credit conditions shift, the momentum you're celebrating becomes the liability you're stuck with. So the numbers, they're real, but the foundation, still fragile. The hidden number no one's talking about. You can report profits, you can post growth, but if your business bleeds cash, it's not healthy. It's leveraged, and that's the part nobody's talking about. SoFi's levered free cash flow margin is negative 99.7%. For every $1 in revenue, they're losing nearly $1 in real cash after servicing debt. That's not a typo, that's not an opinion, that's the math. And here's what makes it worse. This number doesn't appear anywhere in the earnings presentation or earnings report. They don't talk about it on the call. They don't flag it as a risk. You only find it if you know what to look for, and most people don't. Instead, they highlight adjusted EBITDA. They showcase non-GAAP net income, the numbers that look clean on a slide but hide the parts of the business that matter most. This is exactly why I don't look at businesses like everyone else. I have a master's in information management and 2 degrees in business. I've spent years breaking down what most people ignore, and this is one of those moments. Nobody's talking about levered free cash flow, but once you understand it, you see the risk others miss. And sometimes seeing that risk is the difference between a solid investment and a painful exit. Because here's the thing, it's totally possible that SoFi builds a massive business and what's under the hood doesn't matter if they win, if they keep scaling, if the debt keeps spinning. But if they stumble, if origination slows, if credit conditions tighten, then this is what cracks the business and almost no one's watching it. So yes, the earnings report looked great, but until this number flips positive, SoFi is not self-sustaining. They're profitable on paper, but they're bleeding in real life. SoFi's moat isn't there yet, but it's getting closer. Most companies never build a moat. They rent attention, they chase volume, they sell price, and when the cycle turns, they disappear. SoFi's trying to build something different, and this quarter, they made real progress. Fee-based revenue now makes up 43% of total revenue, up from 38%. Their cross-buy ratio hit 40%, which means almost half their users are using multiple products. The more someone sticks with SoFi, the more products they adapt, the harder it becomes to leave. That's how moats are built. They also own Galileo and Technisys, giving them control over the B2B rails and the core banking engine underneath it all. That vertical stack gives them leverage, and this quarter you can finally see the efficiency showing up in the numbers. But let's not get ahead of ourselves. This isn't Apple, this isn't Visa, this isn't a Fortress. Not yet. Right now, the products are still commoditized. The tech stack isn't special. The switching costs are low. And for every step SoFi takes forward, there's still a platform like JP Morgan or Apple Pay expanding behind the scenes, ready to close that gap. SoFi has the blueprint for a moat. It's vertical, it's brand driven, it's sticky, but it's not locked in. And until the business becomes harder to compete with, not just bigger, you can't treat it like a long-term compounder. Not yet. SoFi crushed earnings. No one's denying that. But high-performing quarters don't erase structural risk. They just cover it up until it doesn't work anymore. Here's what still makes this business vulnerable. First, revenue is concentrated in lending. Over 56% of total revenue still comes from originating loans. That means they're not just exposed to consumer behavior, they're exposed to credit markets, interest rates, and macro volatility. When loan demand drops, everything slows down and the revenue engine stalls. Second, they're bleeding real cash. Like we broke down earlier, their levered free cash flow margin is negative 99.7%, and SoFi doesn't mention that number anywhere in their earnings materials. You have to dig to find it. That's not an accident. If you think debt servicing doesn't matter, wait until the economy tightens and that cash burn starts limiting options. Third, they're still not defensible. They're building a moat, yes, but competitors are catching up. Legacy banks are modernizing. Big tech is moving in. The only way SoFi keeps its edge is if it turns its infrastructure into a full platform and scales like hell before someone else cuts in front. And let's be honest, none of this risk is priced in. The stock's up 124% year to date. The PE ratio is 64. That's expensive for a company that isn't cash flow healthy and still depends on growth to survive. If anything goes wrong, this doesn't correct, it drops. So if you're holding this long term, understand what you own. It's not a Fortress. It's a startup with momentum, riding a very narrow line between breakout and blowback. The bottom line, is this a good long-term investment? It's easy to fall in love with SoFi. The brand is strong, the product is slick, the user growth is impressive, but long-term investing isn't about falling in love. It's about asking one hard question. Can this business defend itself over time? Right now, the answer is not yet. Here's the bull case. SoFi is building a modern, vertically integrated digital bank. They own the rails. They're expanding non-lending revenue. They've got product stickiness rising and platform potential with Galileo and Technisys. If they scale that infrastructure and reduce their dependency on lending, this becomes a real compounding machine. And now the bear case. They're still bleeding cash. The negative 99.7% levered free cash flow margin isn't a rounding error. It's a structural problem. Over 56% of revenue comes from lending, and if that engine slows, everything slows. There's no wide moat, no pricing power, and no clear path to positive cash flow once debt service is baked in. Is the business getting stronger? Yes. Is the model defensible? Not yet. SoFi has an emerging moat, not an entrenched one, and until that shifts, this stock is a high-risk, high-reward trade, not a sleep well at night, long-term hold. The bottom line, my thesis is neutral. I don't hate it, I don't love it, but I respect the growth and I watch the risk. And unless that cash flow story flips fast, this isn't something I'd anchor my portfolio to. So here are the hard questions. Is the business getting stronger every quarter? Yes. Are the numbers trending up across users, deposits, revenue, and platform growth? Yes. Is the product becoming harder to compete with? Not yet, but it's getting there. Here's what matters. SoFi just delivered its strongest quarter ever. The brand is scaling, the tech stack is real, the deposits are sticky. But once you dig into the capital structure, they're still bleeding real cash. They're profitable on paper, but when you include debt service, it's a different story, and the market isn't pricing that risk in. The stock is up 124% year to date and trading at a 64 PE. That's not cheap, that's priced for perfection. And I don't bet on flawless, so here's what I'm doing. I'm not investing long term until I see true sustainable positive free cash flow. Not adjusted EBITDA, not non-GAAP net income, not financial gymnastics. But I am watching for a swing trade setup. If the chart gives me the right signal, I'll trade it. I'm not interested in holding this while hoping the risk unwinds itself. Because SoFi might build something massive, or it might break under its own weight. Either way, I'm not guessing, I'm executing. So my thesis is neutral. The upside is real, so is the downside. And if you're going to play in that zone, this is not a cornerstone stock for your portfolio. It's a calculated gamble. Size it accordingly. And no, I'm not a SoFi hater. Every time I do a breakdown like this, people show up in the comments and say I'm a SoFi hater. Let me make this real simple. I'm not. I think SoFi crushed this earnings report. I think they're doing a lot of things right. I think the vision is huge, and I hope they win. But just because I don't call it a long-term hold today doesn't mean I'm rooting against it. It means I have a framework, and that framework says no moat, no long-term capital. Right now, SoFi is building a moat, but it's not defensible. The product is good, the vertical integration is real, but the business still depends on lending, and it still bleeds cash once you account for debt. And for long-term investors, that's not nitpicking, that's everything. A moat protects you when things go wrong. It creates pricing power, it limits churn, and it gives your business time to fix problems without losing too much ground. Right now, SoFi doesn't have that. You might see things differently. You might believe in the vision. You might be early and right. That's fine. We're just using different scorecards. Me, I don't buy dreams, I buy durable advantages. And if your system says SoFi is worth the risk, then take it. Own it. Ride it. You do you, boo. Now let me ask you something. Who else is breaking down SoFi like this? Who else is calling out the real levered free cash flow bleed while everyone else is cheering the headline quarter? Nobody. Everyone's hyped about profitability, but no one's looking under the hood. That's what we did today, and that's why this channel is different. That's why I'm up over $2.92 million this year, sitting at an 83.83% return with over $6.4 million in real capital deployed. Not in theory, not in fantasy. This is execution, and it's not just me. Wreaks Havoc pulled a $4,362 win on NVDL, followed by another $7,170 run-up, just on one move. Same guy scalped Amazon calls for a $680 gain on the same morning he bought them. This is happening inside the Discord every day. People aren't hoping, they're building real momentum. If you're a long-term investor or swing trader, you need to check us out. Inside my Patreon, you get real-time trade alerts with entries, exits, and the reasoning behind every move. Daily market analysis with no filler, no fluff, just the signals that matter. And access to the same strategy I use to scale seven-figure positions with discipline. And the most execution-focused investing community I've ever seen. It's only $30 a month, and that's nothing when you see what it's doing for others. Instead of blowing $30 on bullshit, put $30 into something that could actually make you better. And if you don't 3x your investment in yourself, cancel it anytime. Are you going to keep watching other people win, or are you ready to become the one people talk about? You can scroll or you can scale, but either way, don't say you weren't told.